Well, that was some technical difficulties. Hey, everyone, it's Aaron Morrow and Bryan LaFlame here, local realtor in the greater Seattle area and local resident or Washingtonian, Bryan LaFlame, powered by Movement Mortgage, this lender right here. I'm going to replace, I don't know where my background went. I think I just do not have a good connection right now.
It's much more homey.
Okay, we'll work through it. Put it on the background. Today's podcast, we're going to be... Oh, you like that? The black? You want the black?
No. I thought you just meant behind you, behind your head.
Let's put it on. All right.
Oh, this is sleek.
Oh, behind my head. Okay. Well, anyways, guys, today our podcast, we're going to be talking about you will never be able to own a home. No. But we are talking about like why they're so high and how much they affect your home buying power. And we're going to be talking about also what it looks like.
How many of you have said that? I will never be able to buy a house.
Why it might not be necessarily a good idea to wait.
Yeah. How many of you have said that exact same thing?
How many feel like you're between a rock and a hard place where you're like, you feel like, yeah. So that's what we're here for. Hey, Bryan, are you getting feedback on my end? Like, am I chopping up?
Super choppy. Yeah, this is not starting well.
Wow. Something came through. Okay. So I'm gonna bring us right back in. Yeah. Hold on one sec.
Oh, so much better now.
Okay, I'm going to try that. I reset it. We'll see if this works. It could be my internet connection, so not sure, guys. Hopefully it's not another choppy day. I should have checked that first before coming in here. I'll check it next time. Anyways, we're back. So, Bryan, why are interest rates so darn high? Huh?
You guys remember that guy that ran for mayor of New York on the rent is too damn high? He had like the upside down boot hat. Interest rates are so high 100% because of Fed intervention and the effects of the pandemic on supply side economics. Modern monetary theory might say that it's because, or most people would say it's because of all the stimulus that's been added to the system. And the amount of cash that has gone into the system. Modern monetary theory would say that's not it. It's all supply side. The reality is it is both. And as inflation got out of control, and you got me because you're frozen. Nope, I don't think you got me. Are you super choppy?
I'm frozen still?
Are you hearing me?
I can see you. Are you frozen?
You're back. Okay, good. Yeah, good. So it's about Fed intervention and whether or not or when they're going to pivot from a quantitative tightening position to a quantitative easing position. A lot of you guys have been in on these podcasts, and we've explained what that quantitative easing and quantitative tightening is. In layman's terms, quantitative easing is a softening or a more like stimulative economic policy. And quantitative tightening is trying to take money out, a more restrictive monetary policy. So accommodative versus restrictive, putting money in versus taking money out. During COVID, the Fed's balance sheet increased from $4 trillion to almost $9 trillion. They have been slowly tapering that down. But there are other places where they have been reintroducing capital into the market. So liquidity has not really come out during this quantitative tightening period. And it seems to me that sorry, I lost my train of thought. It seems to me that the Fed is really just loading bullets in the chamber for a recession.
Really? Like, so just like prepping for it, huh?
Yeah, making sure that they can have their balance sheet come down a bit so that they can add to it, setting up a time where they can drop interest rates so that they can add to them. There has been 4 times in the past 40 years where the federal funds rate has been above the 10-year Treasury yield. So even if those don't matter to you, just know it's only happened 4 times
Right.
in the past 40 years. And each time that it has happened, the Fed funds rate has moved down quickly right after, and we've gone into recession every single time. Now, we again had the federal funds rate at 5.25% or so, and we have a 10-year Treasury right now at 4.4%. So we have the Fed funds rate above the Treasury rate. The Fed already talking about what it needs to see happen in order for it to cut rates. As that happens, interest rates will come down as well. So rates are high right now, post-pandemic, starting off with inflation and then moving on to a stronger than anticipated economy, sticky inflation and a stronger than anticipated economy, having investors move out of these longer dated securities, like a 10-year and a 30-year treasuries and mortgage-backed securities. And as that money moved out of it, not a lot of money was left there to soak up that demand. So there's a whole lot of reasons. Those are 2 why interest rates are high. Has to do with treasury supply, has to do with investor appetite within the mortgage-backed security market, has to do with the Fed buying $140 to $160 billion a month of mortgage-backed securities and treasuries during the quantitative easing period in the pandemic. Has to do with stimulation of the economy and how that affected inflation. It has to do with shutting down the supply chain. It has to do with Fed sentiment moving forward. There's a lot of factors that go into why rates are so high, and people just want to know, when are they going to go down? Or are they going to go down? And then what happens if they do
go down, right?
Yeah.
Okay.
I will put your worries at ease. Yes, they are going to go down. No, that is not going to be great for your purchasing power. I want to share something with you guys that shows the effect of interest rates going down.
Let's go ahead and do that.
If we can show,
I think you're gonna have to re-put it in here. Sorry for having to refresh that. So, and while you do that, guys, I'm gonna drop our contact info in the chat. And for anyone, as a reminder, since this is also in podcast form and you're listening to some of the stuff, and whenever we're showing anything off, you can always go check out what we were showing off on my YouTube channel, or basically you could find this anywhere like LinkedIn, because we're live right now, LinkedIn, Facebook, Clapper, TikTok. But it's easiest to find on the YouTube channel because everything's indexed there and libraried. So.
So while you're doing that, before we get the screenshot, a lot of people think as rates go down, you can put it up now, as rates go down, my purchasing power will go up. So let's take a look at what that means. Now, this is a for instance scenario in King County of purchasing a home at $600,000 with 5% down now, and or just waiting 6 months, 1 year, 1.5 years, 2 years, with very, Aaron and I, we do not straw man an argument. These are very just normal numbers with costs and benefits included. I used historical appreciation, so we're not making anything up. And I used a pretty conservative rate projection of rates going down to 6.375 by the beginning of next year, 5.875, and then just staying there. So I don't even have them going down further than that, which as the Fed moves is not going to be the case. And we have an entire class on that that's 3 hours long to talk about why. So purchasing a home now at $600,000 with 5% down in King County versus waiting 6 months, 1 year, 1.5 years, 2 years off historical appreciation. Look at the numbers that change here. So not only is this house going up, but you're saying, yeah, Brian, but I'm buying it at 5.875 instead of 6.875. While that may be the case, I want you to take a look at the principal and interest payments. Principal, interest, taxes, insurance, mortgage. So your entire payment, what that's going to look like over buying a house at $600 for 6.875, $44.17 a month, versus buying a house at $670 for 5.875, $45.09 a month. So you can see that it is not that much cheaper per month to wait, and you miss out on all of this equity. Waiting 2 years will cost a person about $69,243. The monthly payment's going to be about $90 difference, but it costs you, and that is appreciation gain, cumulative monthly payment difference, and taking in the cost to refinance down to that lower rate. If you were to refi to that lower rate, so even if you weren't to refi, it would cost you even more. This is the effect of higher prices even with lower interest rates. Now, if we were to be a little bit more reasonable about where we think rates are going to be in the mid to low fives at this time, this would be even more pronounced because this purchase price would go up even further. I want to show you guys some stuff that we do, that we share.
Your family. I want to show you my family. No,
classes.
just kidding.
I want to show you who you're feeding when you help us. So I want to show you guys some stuff that we go over during our home buyer classes. This is how a mortgage is made. Enough said. You guys know this now. But I want to show you that currently, it's in here somewhere. Here it is. With interest rates in the sevens, okay? Mortgage purchase app. These are mortgage purchase applications. How many people are putting in mortgage applications to buy a house? Are at levels that are at so low, we have not seen these levels since 1995. At first blush, you think, that's awful. I don't want to be in this market. You remember Warren Buffett's famous saying, when people are scared, be greedy, and people are greedy, be scared. So right now we have the last time mortgage purchase, the last time this few amount of people were putting in applications to purchase homes, Griffey was rounding third base on Edgar Martinez's double, sliding into home, and the Mariners won their first playoff series in franchise history, coming back down 2-0 to beat the Yankees in the 1995 AFC Wild, or AFC, that's not football, AL Wild Card to go to move on.
And that was 90. Yeah, that was 95.
95.
Right?
How old were you in 95, Aaron?
Wow. Oh man, don't ask me to do basic math before I've had my coffee.
Yeah, I was in.
Brian, you helped me.
Grade.
I am 34 right now. 95.
What year were you born?
89.
You were born in 90.
Hold on. 89.
You were born in 90. This is the easiest math.
Right? No, I was born in 89. 89. So
it's still easy,
right?
You're 5 and 6 years old. Yeah.
Oh my gosh.
Mm-hmm.
I'm cutting that part out. No.
So it happens, guys. Okay, so that's okay. Purchase application is at its lowest level since 1995. Now, what has that done to real estate prices? I'm so glad you asked.
Yeah.
The Case-Shiller Home Price Index, which is the gold standard for home pricing, has gone up 6.6 or 6.4% year over year. Housing prices continue to increase as rates stay high, as home buyer demand comes out, as inventory has climbed. Where are we? Weekly available inventory, you can see, look at how much higher it is in 23, 22, 21, and 2020, yeah. But how low it is compared to the pre-pandemic levels. So we've had mortgage purchase applications plummet. We're starting to see inventory go up in a reasonable and real way. And we still see home prices going up 6.5% over historical averages of 5 to 6%. Why is that?
That's correct.
It's because if you were to look at just inventory coming up, and you'd say, "Oh my gosh, look at this! Inventory is coming up. This is bad for the market. We're going to have a whole bunch of homes in the market, and prices are going to plummet." Or you could look at historical mortgage inventory trends, and you could see how horribly historically low we are. So sure, inventory is coming up, but it is coming up from such a low level that it has so much further to go just to get to normal. Now, why are we saying that if you wait for rates to go up, it's not going to be cheaper to buy a house? Right now, higher interest rates will continue to add more inventory to the market. Higher interest rates are going to continue to add more inventory. They will add more weekly, and they will currently are adding more weekly inventory, and will add more inventory that stays on the market. Why is that? It's simple demographics, and it seems counterintuitive to say, hey, people have 2 and 3% rates, so if rates stay at 7%, there's not going to be as many houses on the market, and that's no way that it can grow. But the reality is people have to move. People get divorced, people die, people have babies, people change jobs. Like, things happen in people's lives that make it so that they have to move. That's always going to happen. What is happening right now, though, is first-time home buyers who are incredibly interest rate sensitive. 97% of first-time home buyers, 93% of first-time home buyers finance their house. They don't have a rich uncle that died and left them money. They don't have parents who could buy it for cash. They have to get a mortgage. So they're very interest rate sensitive. They're staying out of the market right now. And last year, first-time home buyers in a normal market, 33% of the market. Last year, they are 55% of the market. Okay, so that's a big demographic that is just not moving as quickly or in as big of droves as they have before.
Right.
What happens when somebody, I'll have some other slides to share too if you guys want to look on YouTube. So what happens with, what happens when somebody puts a house on the market? Well, if that person needs to buy a house, they put a house on the market and they buy a house. So they're a net zero to inventory. What happened during this time with a bunch of foreclosures and inventory spiking so high, as you can see from these slides, inventory spiked so high because in 2008, 2009, 2010, you'll remember people had bankruptcies, they had foreclosures, and they had these large short sales. They had these large events. Look at this climb in bankruptcies and foreclosures pre and into the Great Recession compared to what's happening right now. So these people who foreclosed, bankruptcy, short sold, they got rid of their house. They couldn't become a buyer. They had to then be a renter. So what's happening now is you have people who had no credit events, but they need to move for whatever reason so they can put a house on the market, and then they're going to go buy another house. That's a net zero. We do not have first-time homebuyers coming in. When first-time homebuyers come in, as interest rates go down and first-time homebuyers start to move back in the market, you and I saw it at the beginning of this year. We saw it at the beginning of this year when interest rates
had that dip. Like, was it January or February? I can't remember. Was it?
Yeah, from October last year into January of this year. So this dip right here. So as we saw rates start to go down, we saw an influx of first-time home buyers. It was like they were waiting and couldn't wait any longer, and just they're very interest rate sensitive. When they come into the market,
the vast majority of them didn't scoop anything up. You know.
No, but their interest, because it didn't last long enough. Their interest was peaked. Those people have nothing to add to the market as a listing. So they're going to come off and just gobble up these listings that people are putting on the market for life reasons. And then you have first-time homebuyers coming in, just taking listings off the market without adding to it. We're going to show weekly listings going way up, but we're going to show them sold incredibly quickly. I want to show you a little bit of perspective of what we have right now versus what we had then, and how prices are going to be affected. In 2007, we had 4 million homes for sale. This is under contract and not under contract. In 2024, right now, nationwide, we have right around 1 million. This number, I think it's like 1.03. This fluctuates a bit every week.
Less than a fourth.
Yeah. And we have 13 million more home buying households vying for these 3 million fewer homes. Mm-hmm. Now, that is only going to drive prices up as rates continue to go up. This is what's happened to real estate prices post-pandemic. So I want to show what most people will look at as oh my gosh, this is such a crazy time. I can't believe prices are coming down so long. We did a class in the middle of 2022 about people calling for the market crash. And so what I did was I went back for 10 years, from 2012 when the market rebounded from the recession until present day of 2022 at the time. And every year I looked up what people had said the market was going to do, what we said the market was going to do, why they said it, why we said it, to show that no, like this, if it bleeds, it leads. Bad news is what's going to get people to click. But here's the reality of what's happening in the market. So people would see these prices coming down, what looks like prices coming down. This chart shows Case-Shiller, National Association of Realtors, and Freddie Mac's home price index. So it's 3 different data sources showing prices going down. But that's not actually prices going down. If you look at this axis, it is prices growing. It's going up less quickly. So the growth rate of these houses is going up. As we bottomed out here, a lot of people are like, see, I told you, interest rates housing prices are going to crash. Housing prices are going to crash. We bounced right back up because of course we did, because they didn't understand the actual problem we have in the housing market right now. So if you were to if we could just block out this period right here, this COVID period, if you can see what I'm squaring on my screen, if you could block that out, look how smooth this would have been. We're just right back to the median, right back to the mean. So people who are saying,
you're right.
Yeah, we can't buy a house right now. We're going to wait for rates to go down. I'm telling you, as you wait for rates to go down, this is going to go up. It's just going to have to. Demand is going to be pushed into this market. I want to show you kind of an example of the demand this time versus the demand when we had our last real estate recession. First-time homebuyers born in 1973. Look at this huge dip in the amount of first-time homebuyers that came to the market in 2006. Look at this large influx of population of people becoming first-time homebuyer age, the average age of a first-time homebuyer in 2024. Yeah. This is the amount that is on. This is sideline money right now, you guys. Sideline home buyers, and these sideline home buyers continue to push rental market prices up because we can see we have
which is great for the
very low
investors,
vacancy
you
rates.
know.
So great. If you're an investor, it's a great time to be you right now. Even at higher interest rates, if you can buy a house with a higher interest rate and refinance to a lower rate, you can get into a market that is thirsty for you. So as interest rates come down, we will see home prices and competition continue to go up. It is a thing that we're preparing for on our team. It is a thing that we make sure that we are going to be able to handle the amount of business that is coming in, because we're still incredibly busy right now. And so as this moves, like, it's going to be a huge, like, you've got to be ready. And if you're a home buyer on the sideline and you're waiting, you got to get in the game before everybody else. You got to get in it before it's crowded. We talked about, hey, I can't buy a house right now, and so I'll never be able to buy a house unless rates come down. Then I can jump in and buy a house. I think we've shown what it looks like when rates come down and the reasons why prices are going to go up. They're going up in a high interest rate environment with increasing inventory and diminishing demand.
Yeah.
So as rates come down,
and it's already, and Brian, it's already crowded, like on the east side. So like with these high interest rates, I have buyers that are trying to buy on the east side, Bellevue, Mercer Island. They are getting spanked when it comes to just beat up on the price. So like there are multiple houses in these areas that they're listed for, just slightly above $1 million, and they're going for 400, 500,000 above list price. All of them. And they're all cash or hard money deals. The normal home buyer that's trying to buy these properties on financing, they have to basically waive everything to compete with it. You know what I mean? And fork over like a good amount of earnest money to say, here you go, seller, to take the risk of using me as the buyer versus, this other cash offer,
Absolutely.
Yeah. And that's going on with the high interest rates. Imagine what's going to happen when they come back down for those areas. Like if you've ever wanted to get in those areas, like it's a pipe dream right now with like right now is like probably going to be the easiest time to get in those areas. And it's not, it's tough. So like, I'm just thinking of all my buyers that was helping through the pandemic and pre-pandemic. I mean, gone are those easy days where you just as a normal home buyer can just walk right in and get a house in Bellevue. Like it's going to take grit, tough, to be tenacious. Like you got to think outside the box and go for the off-market deals. Now that being said, every market in every city is a little bit different. On the whole, it's it's generally more competitive right now, but there are plenty of areas in the greater Seattle area where it's not as crazy. And if you even look at it, there is still a sign of hope right now while interest rates are higher, because we were just taking a look at our chart, our team today. I think there was like 1,400 new listings or something that came on this last week or something. And I might not have the numbers exactly correct, but I remember like the general ratios. There were still over 300 houses last week, listings that had price reductions. So there's plenty of houses out there that are still on the market, that hit the market, that didn't get a crazy bidding war happening on them. And a lot of the times there are going to be multiple factors. They didn't list it properly. They didn't advertise it properly. They picked the wrong price. They're overlisted. There's numerous factors, but guys, there's 300 homes out there currently for sale right now that just had a price reduction, meaning it's still on the market. Those price reductions go away when interest rates pop back down below 5. You best believe those price reduction amounts are going to be like next to none. And then
you've got to change your way of thinking.
Are going to be like next to none. Yeah.
You have to change your way of thinking too. If I'm thinking this, everybody else probably is too. So how can I outthink that? Hey, I really want rates to go down so I can buy a house. I bet you do. I bet we all do. I can't control that. What I can control is my strategy for this market and where I think it's going. I want to talk a little bit about what's going to happen moving forward with rates and what matters to the Fed. So the Federal Reserve has a dual mandate of price stability and and a robust job market. That is the reason that they exist. They are what's called the lender of last resort, so they can keep the economy stable and they have an active and robust job market. So the two best ways that the market measures that is our inflation numbers and our jobs numbers. And that is what the market trades on big time. I want you guys to take a look at this. Now, you don't have to understand what it means, but I just want you to see this large movement, which is when April's consumer price index, which is the first inflation report of the month, and the market trades heavily on that. So this is a consumer price index, and look at this trading volume compared to the rest of the month. It is by far the highest. So all you got to see is what investors do with their money. Now look at this jobs report. It was a jobs report that was positive for us, and it is always the first or second highest. If it's a big miss or a big beat, it will be the highest. And then you can see the volume today, or excuse me, not today. This was a couple of days ago that we made this. The volume, my buddy Matt Graham made this. The volume that you could see from the CPI report that just came in at expectations. Here's a little bit better look at the volume from the CPI report versus the jobs report, and look at this difference in trading volume. What investors care about. Jobs. This is a positive jobs report for us. You can see interest rates come down as we added fewer jobs than expected. The consumer price index that came out a couple of days ago was as expected. So consumer price index went down from 3.8% year over year to 3.6% year over year.
Right.
And then look at the trading volume. Trading volume. This daily, look at this trading volume and this large move down when it just came in as was expected and not a bit worse. So the Federal Reserve has a target of inflation that their inflation target is 2% annual inflation, measured by the PCE. And that 2%, I wrote a post on it the other day, that 2% has not always been set in stone. It's really only like officially 12 years old. Unofficially, it's like 30 years old. But it is just a number that the Fed needed to say, hey, we need a number so people know what we're going towards and we're not just reactionary. And so that number of 2% inflation is a number that they just said, hey, yeah, this is it. They had their economic reasons, which we don't need to go into, but they made a number so that they could have a target and that they could the market would know what they were moving toward and why. So the Fed has stated now that they've raised their federal funds rate all the way to 5.25%. They had stated in this move down last year that we just looked at, this move down in interest rate.
Right. Yeah.
This was the first time they stated publicly, hey, we think we have some rate cuts next year. So if we have some rate cuts next year, you saw the market react to that. The weird thing is, the Federal Reserve's federal funds rate is the shortest term loan available. It is an overnight loan. And the 30-year fixed mortgage is one of the longest term loans available. But the Fed policy is affecting the value of our money, and the value of our money is very important in a long-term investment. If you have a fixed return and your money continues to get less and less valuable, well, then that return becomes less and less valuable. Think about if you get $2,000 a month from this 30-year fixed asset that you bought 3 years ago. Well, 3 years ago, that $2,000 bought you a lot more than it does now. So that asset is a lot less valuable.
Right.
So that's why it's affecting the long-term market. As the Fed said, hey, we think we see 3 rate cuts next year, the market reacted. Yeah, right. And now as we started to get negative jobs numbers and negative inflation numbers, you can see it right here. You can see it right here. You can see it right here. You can really see it right here. These are all negative jobs and inflation numbers. Positive job inflation number. Positive jobs number. Yeah, you can see these huge red moves. These are negative. Every one of them is negative jobs and negative inflation. So the Fed, now that we've had a positive jobs report here, positive for the bond market, negative for the economy, and a positive inflation report here, positive for both the bond market and the economy, you can see that the sentiment is, hey, maybe we will have a Fed rate cut this year. Now, I wish I would have saved this chart. There's a chart of Fed fund futures, which is where the market thinks the federal funds rate is going to be into the future, and the 10-year Treasury market. And the Fed funds futures is still up here. So the market isn't quite sold. They need some more data. on inflation numbers and jobs reports. But if we go into June and we get another negative jobs print, it is going to be gangbusters for mortgage interest rates. And that's going to push activity huge into the market, and you got to be ready for it. This could be another head fake.
Absolutely.
We can look back and we can see this head fake. I mean, look at where mortgage interest rates were in March of last year. And then we got some positive economic data. Or no, this was actually Silicon Valley Bank going under, and the commercial banking crisis.
We made a whole video collab on that. Yeah. Right.
Yeah, we sure did. And then you could see the Fed stepped in and gave them some money. So this head fake here, we had this head fake here, this November 10th of our first positive inflation report in 2 years. And we had this move down, head fake. Move down, head fake. We went all the way up here. This move down, head fake.
Right.
Now, as we start to move down, if this continues, is it a head fake or is it not? This time
Brian,
feels like
we're getting a spike
of
new viewers, by the way. If you could explain head fake term for the new viewers.
Yeah. So head fake, think of it like this, like think of it in basketball. Like I'm going this way, but I'm just going to stay here. So the market is faking this out. Like they're ready to go down. They're ready to go down, but they're not yet. And the reason is we had some positive Fed talk here about the Jerome Powell was very, very clear that he just needed to see more positive inflation data moving forward. And right after he said that, we had 3 consecutive months of negative inflation data. So the market reacted. The Fed has also said if the jobs market doesn't need to crack before they cut rates, but if it does crack, they will probably cut more quickly. And now we've seen our first report of the jobs market maybe showing some cracks. So if that continues, then we are on a downward trajectory. If it does not, we may come back up. There's a lot of people who think we'll see 5.5 again. What we don't know, what we can't control is what those numbers will be. What we can control is how we position ourselves for whichever they are. And the only way to do that is to get out in front of the competition. And as rates go down, people are saying, oh my gosh, I'm jumping in the market now. And you're way ahead of them.
That totally makes sense. This is my rendition of, or my take on Jerome Powell, by the way.
It's pretty good.
Yeah. For everyone that just joined in, what we're talking about on our podcast today, what we've been talking about is just why interest rates are so high. We've explained what happens when they're higher, what's going on right now, the difference between or how they correlate and don't necessarily equal. Supply and demand issues are a completely separate thing. We've been talking about why even when the interest rates are higher, supply being down and demand being up, just simply having a market that's resilient to higher interest rates is still having increase in equity, increase in how much more expensive homes are getting. We've been talking about all that, and then the cherry on top, we have been hammering at home of why it's not always the best strategy to wait for rates to go down, especially in a market like this where supply is such an issue and demand will always be up based on the factors that are going on, not only on a nation level, but also locally with our local economy here in the greater Seattle area. So we've just been chatting all about that. I'm going to let, I know like this is kind of on the tail end of what Brian's been talking about. Also for some housekeeping items, I did get a comment in here, so I'm just going to throw it on the screen. Barbara, thanks for commenting from LinkedIn. I can never tell how many people are watching on LinkedIn, but Barbara, I will reach out to you after our live to chat with you. Sure. I'm always up to meet new people. So great. Fantastic.
I think the thing that we want to keep in our mind is counterintuitively, we do not get more inventory as interest rates come down. We get more new listings.
No,
worse. They come off too fast.
Get gobbled up quicker. They'll get gobbled up quicker.
Yeah. We are already seeing people waiving their appraisals. We're seeing 5, 10, 15, 20% above asking price. I've seen it in the $400,000 level, which is more first-time homebuyer level down in Pierce County and Thurston County. And I've seen it in the $2 million level over on Mercer Island in the east side. It is happening. Yep. And so it is not going to get better as rates go down.
No.
It just isn't, you guys. And I don't want you to look back and be like, man, I wish I woulda. We're not saying you got to make a move. We're not saying that you should do a thing that you're not ready for. We're saying that you should absolutely explore it so that you can be ready as soon as possible. And then once you're ready, the control is in your hands on when you make the move that's best for you. Just take a look. Just see. Don't wait. Don't wait like everybody else is waiting. And then, the amount of money that will cost you, or the amount of house that you won't be able to get because of that, is going to be it'll be sad.
I agree. Now, I will still hit home that we have plenty of other live podcasts that are on the channel that you can check out. Of one that goes over, it weighs the pros and cons of renting versus buying. So you should check that out if you're trying to figure out if whatever season you're in your life right now, if buying is right for you versus continuing to rent. That's a good one to check out because it's a very, we're just looking factually at the numbers. We do not lean them one way or the other in a
spoiler alert, for some people it's better to rent.
Yeah. For some people it's a lot better idea to rent for them. But like check that out, because if you're like trying to get a foothold on what's right for you, of course. Now, if you want to talk about, shameless plug here, if you want to talk about your super specific situation and dial it in, we're here for you. So reach out to us. You've got my contact information below in the comments, so we can schedule a time, a consultation. It doesn't matter. If you're here local, great. If you're anywhere in the United States, that's great too, because I'd love to get you introduced to a local team that can help you with your home buying goals. It just helped us with a buddy of mine too, refer to a fantastic agent in Missouri. So like we can chat, have that conversation, get that ball rolling for you.
Also, if you want to live in Missouri, we will hook you up with a good therapist, because wow, what sort of poor life choices do you have? The state is literally called Misery. Oh,
Missouri. Oh my gosh. Well, that loves company. I'm going to bring up on the screen here, guys. So this was a recent closing of mine. Yeah, this is Katie and Chris, guys. So Katie and Chris, past client spotlight, or not even past client, like this just happened. They just got the keys to their brand new home, guys. And this was 4 years in the making. So finally, like one of my longest clients that I've worked with, helping them go through the home buying process. And the reason why they were working with me is there was no pressure on a timeline. Like there was no like, you need to get in a house or I'm not interested in working with you. I mean, at least they're going to convey that in the, they did a really nice video testimonial for me that will drop on the channel in the next couple of weeks. But really working with these guys, it turned into a long-term friendship, helping these guys out, find something. And you know what's interesting? They ended up buying a house that, in my opinion, was what they told me they did not want originally. And now like, they're like, actually, as we've grown, they had a child and this kid's now 3 years old. What they wanted changed a little bit, and we were able to find them something. And it ultimately ended up being a little bit pricier than what they originally were looking at 4 years ago. But strategically, it was actually a better time for them to buy based on interest rates being higher, even though competition's up. It's not as bad as it was when they were looking during pandemic. So we were able to get them this really good deal. And guess what? It was off market, baby. Love those off market deals that we're able to find clients. So, yeah. And what I mean by off market, anyone that's watching right now, that's like, what is off market? The term, basically just a house that's not for sale on the multiple listing service. So like this house was, it was actually gonna go for sale soon. But we were able to find this out. Now, again, this is different for any brokers that are watching this. This was not a pocket listing. I was not approached by the listing agent. I actually cut them off, or like got to the seller and the listing agent a week before they were going to go live. I found this out, got all this information, and approached them with this offer. And we made a compelling offer that seller decided to take the gamble and move forward with our off-market deal. But it still saved them money because there's other houses in that neighborhood that are listing for a lot higher than what this house was listing for. So I was stoked for this, guys. This was like a Cinderella story, or one of those like happily ever after. I'm just glad for them. But guys, that's the whole like idea. Look into what's best for you as far as when is a good time to buy. But guys, they were looking for like 4 years and trying to figure out what worked for them. And there's plenty of clients that I meet and they're not ready for another year or two. And, you know, we develop that relationship and help them, guide them through that process. So that's the thing. Everyone's home journey starts somewhere. And I always say worst case scenario, like if you get in touch with Bryan, you know, as like a mortgage lender, it's always a good time to figure out if right now is a good time to buy for you. And the worst answer you're going to get from Bryan, because some people don't even reach out because like they're afraid of like getting rejected and not being able to buy. The worst answer you're going to get is, hey guys, we just don't qualify right now, but if you do A, B, C, or D,
there's no in mortgage.
You know? Yeah. Yeah, there's no in mortgage. Yeah, that's true. That's true. So guys, that's kind of what I just wanted to show you today. I hope we hit enough of it home. If you have any questions, let us know. You've got our contact information. You can reach back out to us later. Just like, again, one last shameless plug. All of these guys did it. They all became homeowners, and a lot of them they're all of us. They are the everyman, the everywoman, the everyday person that's just trying to buy a house. And half of them did it through pandemic. Just now, before, it doesn't matter. You can own a home if you want to. So this right here, the you will never own a home in the background, that's if you choose to. You know, we can get you there. So reach out. We'll come up with a game plan and figure out how to get you there. Sometimes it's just it's a long haul, but we're in it for the long haul, baby.
Could be a day, could be a month, could be a week, could be a year, could be 4 years like those people. It doesn't matter. Your journey is your journey.
Don't listen to Jerome Powell. You can get a house. No. Open. Anyways, not going to get sued for.
Look, no, Jerome listens to. I have it on good authority. Jerome watches and listens to his podcast every.
He watches his podcast. Yeah, he's like
100%.
Aaron. I don't like how you made myself look in that one thumbnail. No, just kidding. It's here. This house on fire in the background here. Pretty dramatic thumbnail. But anyways, guys, if you have any questions, please feel free to reach out to us. Again, Aaron Morrow here. Local realtor, your friendly social media neighborhood realtor in the greater Seattle area. I work with home buyers and sellers, primarily in King, Pierce, and Snohomish counties, but I dip into Kitsap too, just because I have a lot of peeps that take me over there. Bryan here can work with you on a local level in Washington and like a couple of other states that I don't care about because I don't service those. But Bryan can let you know what those are. And again, we can hook you up with a local. Yeah, call them to find them out. We can hook you up anywhere in the United States. We will talk with you and get you over to the right people. So contact information is below. This one last reminder: this will drop on YouTube and on the podcast. So check it out. And yeah, we'll see what we talk about in another week because we're like bi-monthly now. So
we'll find out together.
Other than that, guys. Great chatting with you. Any lame jokes, Bryan, to clear us out?
Any jokes to clear us out? No, actually.
Any lame ones?
Up right now.
Dad jokes?
I'm backed up, so I'm not going to be clearing out.
Oh my god. Okay. Hey, have you seen this whole new ChatGPT thing? By the way, it's like freaking me out. Mm-hmm. So ChatGPT, it came out with a new iteration that it's called ChatGPT 4.0, and like, dude, it's so like human like when it's talking to you, like it chuckles and laughs at you and like tries to like I feel like they designed it to try to like I'm not saying flirt, but like it tries to play on like to
have to engage, to have some sort of personality.
Engage, yeah, it's so weird, but like you know what the cool thing about it is though, you can like use it basically like Tony Stark, where it's like your Jarvis, and have it on where you're just like audibly yell out into the universe, I need to know blah blah blah. I know, like tutor you like math and stuff.
Yeah.
So, crazy stuff. All right, guys. Well, we are gonna take off. Talk to you later, guys.